Good morning, venture capital. This is Metagame, and today we're figuring out why the biggest money in the room isn't playing your game anymore. 5.7%. One platform. 90 days. That's what KKR just did to the Q1 capital formation market, and if you blinked, you missed the structural shift underneath it. Here's the hook, and I want you to hold this the entire episode. Private equity didn't show up to compete with venture capital this quarter. That framing is too small. What actually happened is this. PE rewrote the rules of what competing even means in private capital markets. And by the time most VC funds figured out the game had changed, KKR had already filed $14.7 billion in 2 vehicles, walked out of the SEC's EDGAR system, and started building the physical layer of the AI economy. The question isn't whether you saw it coming. The question is what you do now that it's here. Let's get into it. Q1 2026 SEC Form D filings, 1,003 deals, $256.1 billion in total capital. On the surface, that sounds like a healthy, distributed market. 1,000 deals, spread across stages, geographies, sectors. Sounds democratic. Sounds like opportunity. It isn't. 41 deals at or above $1 billion captured $193 billion. That's 76% of all capital from 4% of transactions. The market didn't spread the wealth, it compressed it. Fewer deals, dramatically more capital per deal, quarter over quarter. That's not a correction, that's a structural realignment. The median Form D this quarter was $27.6 million. The average was $255.4 million. Those two numbers being that far apart tells you everything. The distribution isn't a bell curve, it's a canyon. Most of the market is on one side, the capital is on the other. KKR is on the other side. 2 vehicles, filed in Q1. KKR Private Equity Conglomerate LLC, $8.58 billion. KKR Infrastructure Conglomerate LLC, $6.12 billion. Combined, $14.7 billion, both NYC domiciled, both SEC Form D registered. Neither is a traditional venture fund. These are platform architecture vehicles, structured to aggregate and deploy capital at a scale that most VC firms cannot anatomically approach. Let me put the $8.58 billion PE vehicle in context. The average Form D filing this quarter was $255.4 million. KKR's vehicle is 33.6 times that average. It is not participating in the same market most VC funds occupy. It is operating in a different gravitational field entirely. And the infrastructure vehicle, the $6.12 billion, that one has a very specific destination. Hyperscaler capital expenditure for 2026 is projected at $675 billion. The race to own data center land, power transmission, and connectivity infrastructure is not a future trend. It is the current arms race. KKR's infrastructure vehicle was the structural foundation. Then April 30 arrived, and Bloomberg confirmed what the filing was pointing at. KKR had secured more than $10 billion to launch Helix digital infrastructure, a purpose-built platform targeting data centers, power generation, and AI connectivity. The Q1 filing was the setup. Helix was the confirmation. KKR's Helix platform dropped $10 billion to own the physical layer of AI. Your Series B check finances the tenant. That's not a dig. That's the capital stack as it actually exists in 2026. Model companies at the top, OpenAI at $122 billion, Anthropic at $30 billion, xAI at $20 billion, Waymo at $16 billion. Those 4 companies alone represent 65% of the $300 billion global venture total this quarter. Below that apex, infrastructure financing, KKR's vehicles, the CoreWeave $3.1 billion GPU-backed loan, syndicated through bank credit markets, asset-backed structures that have nothing to do with traditional VC mechanics. PE owns the middle and bottom of that stack. VC owns the top. That's the division of labor in 2026, whether you designed it that way or not. Now here's where it gets structurally interesting, and this is the part that should be sitting in the back of every VC fund manager's mind right now. On May 5th, Bloomberg reported that KKR and Blackstone are in active discussions with Google to deliver AI models directly into their portfolio companies. Read that again, slowly. PE firms, as ownership structures, are negotiating to become the distribution layer for frontier AI into enterprise markets. Portfolio companies would receive AI model access through their ownership relationship ahead of open market procurement. When PE starts packaging AI model access into portfolio ownership, that's not a financing move, that's a distribution moat. For VC-backed enterprise software companies selling into those same markets, this changes the competitive frame. It's not a deal flow problem, it's a go-to-market problem. If a PE-owned competitor gets preferred AI model terms through their ownership structure while your portfolio company is still navigating open market procurement timelines, that's an asymmetry worth pricing into your competitive models right now, not in 6 months. And it's not just the Google talks. Bloomberg reported May 4th that OpenAI finalized a $10 billion enterprise deployment joint venture with TPG, Brookfield, Advent, and Bain Capital. PE is not just funding the picks and shovels anymore. It is becoming the sales force for frontier AI at the enterprise level. That is a new market structure dynamic, and it appeared fully formed inside a single 30-day window. Let me break something down directly. When people say PE is competing with VC, they usually mean PE funds are writing checks into growth stage companies that VCs use to own. That's real, but it's the smaller story. The bigger story is structural capability. PE firms access credit markets, preferred equity, infrastructure financing, and asset-backed lending at scales VC cannot replicate. Last year, PE and crossover funds deployed $63 billion into AI deals. Traditional VC deployed $38 billion. That's a 66% premium. And it wasn't a one-quarter anomaly. It reflects what different capital structures can actually do. CoreWeave, raising $3.1 billion through a GPU-backed bank-syndicated loan, is not a venture story. It's a private credit story. That's a new asset class forming in real time, and VC isn't the architecture for it. So where does that leave traditional venture? Here's the honest answer, and it's not as grim as the numbers make it sound. N1 concentration, the mega deal compression, the PE platform dominance, the infrastructure capital race, creates a clear bifurcation. Mega platforms capture the infrastructure and platform layer. That's KKR's territory. Specialized venture owns the application and vertical layer. That's a different game, with different rules, where scale doesn't determine outcome. Vertical AI is up 3% quarter over quarter. The picks and shovels layer for application deployment is real and growing. The opportunity exists. It's just not at $14.7 billion per quarter. The strategic positioning question isn't, how do we match KKR's scale? That question has no useful answer. The question is, are you clearly operating in the layer where scale doesn't determine outcome? And are you raising LP capital that actually understands that distinction? Because if your fund thesis was built for a market where $500 million was large, and you haven't recalibrated for a market where one PE platform files $14.7 billion in a single quarter, you're not competing in the wrong weight class. You're competing in a sport that's been reclassified. Here's where we close the loop. I opened with 5.7%, one platform, 90 days. That number was designed to create a specific kind of discomfort, not panic, but precision. The Q1 data isn't telling you that venture capital is dead. It's telling you that the capital formation market has stratified in a way that demands strategic clarity. The top of the market is a toll booth, 41 deals, $193 billion, and you either have the infrastructure to play there or you don't. KKR has the infrastructure. Most VC funds do not, and that's fine, as long as they're not pretending otherwise. What the Helix launch, the OpenAI PE joint venture, and the Google distribution talks confirm is that PE has moved beyond capital provision into market architecture. They're not just writing checks. They're building the physical layer, the distribution layer, and now potentially the AI access layer of the economy that's forming around us. KKR didn't raise a fund. They filed a market. The only question that matters after an episode like this is whether your fund strategy was designed for the tier that exists or the one that used to. That answer determines everything else. That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.